in a Zoom meeting or over a phone conversation or an email exchange is literally subject to change an hour or two later.
What are you seeing now as far as, just a general overview of where interest rates have gone and what the industry professionals like yourself think where's it going to go?
Yeah, it's a lot of conversations. I mean, You and I talked about this, Nini, I think a week or so back when we were catching up just to talk about the market and what's been going on. But it's everything that gets spoken of in a Zoom meeting or over a phone conversation or an email exchange is literally subject to change an hour or two later. That's how fast guidelines are shifting. The news is shifting. The markets are in. They're just it's just very, very volatile right now on all fronts. You have the financial markets are volatile, and that is coming all the way down to the household. Like there's anxiety in the household, on a human level. You take that all the way up to the biggest of markets and marketplaces, and that anxiety is 10x there. So it's all in between.
Mm-hmm.
So a lot of the measures and things that are coming in terms of banks and investors' reactions to things, or them being proactive with certain changes and certain stances and positions, is to prevent another 2008 from happening. We talked about this. This is not 2008 all over again. The measures that are in place, even though it may not feel like it, and things that are coming down and changes and shifts are to prevent another 2008. Last time it was the housing sector and the banking system that was not well capitalized and very illiquid and over leveraged that effectively caused the global recession. More specifically, here domestically, but obviously that bled out to the rest of the world. This time, the banks in the United States, the banking system, the lending system has so many safeguards, sometimes too many, but in a time like this, it's better to be. But there's so many safeguards, so many checks and balances. They're so well capitalized and liquid that they're actually going to be, as Kevin pointed out earlier, they're going to be the epicenter of what helps lift us out of this. Last time they caused it and everyone was trying to figure out how to save them so they could somehow turn around and save us. This time they're actually in great position to do that because there's instruments, there's government support, there are, there's more capital out there this time around. So people need to understand that first and foremost. They also need to be patient in understanding that, the entire US mortgage banking system is set up to fund on an annual basis, $2 trillion worth of transactions. To give you some context, in early March, when the interest rates crashed, there was a window there where we were literally at historic lows. I know every time the news comes out, they're like, new lows, historic lows. These were the true, absolute historic lows. In the history of housing rates, prior to maybe day one when they couldn't actually issue a rate and it did start at zero and then it had to get adjusted to whatever the market rate was, these were the lowest rates. So there was a moment in there when that happened that the entire system was just completely flooded. And again, for that context, there's $2 trillion that it can handle. Over $1 trillion came in a matter of weeks leading up to it and then in those hours. So like any system that's not set up or doesn't have the capacity to handle that kind of volume, handle that kind of transaction, handle that kind of money distribution, banks completely panicked. A lot of big investors almost closed their doors and they're trying to ward off demand, push people away and say like enough. Imagine like a run on a Walmart for the new Sony PlayStation. And then they just have to shut the door saying, we don't have any more, like that's it. And people are waiting outside with applications saying, I want to lock a rate. I want to apply for a loan. I can't do it. So banks would raise their rates to ward off that demand until things normalized, raise their turn times to really unattractive levels of like, in some cases, 70 days. People are hearing with like underwriting and processing timelines. So they did that. There was also risk out there that banks and investors saw. They're reading the news, which as Kevin talked to as well, as spoke about as well, it's there to shock you, right? And sell ads. So a lot of the shocking information that's coming out macroeconomically is that unemployment is going to hit rates that are double of the last recession. Last recession, unemployment capped out at 10%. We're talking now about 20% or more, potentially. Investors and banks see this. Of course, they see the writing on the wall and they're trying to interpret that and they're pricing in that risk into rates now. And they're pricing that risk into mortgage guidelines. So you're seeing banks advertising this or putting this out. You'll see it in the media that the minimum credit score is now being raised. The minimum amount of reserves are being raised. Down payments have to increase. They want to have so many safe measures, again, to prevent a 2008 from happening. So they're taking these extreme measures, which to the consumer and for us in real estate can sometimes be difficult to accept, but we have to remember that context, right, of 10 years ago and what happened. And there was a certain recklessness or like an absence of these types of, prudent behaviors and measures of being responsible that now are in place to help prevent anything catastrophic from happening to our banking system. So you had capacity issues. There was risk out there. The mortgage-backed securities market, which is effectively the true measuring stick for what is happening to interest rates, that was very volatile. So to answer your question, really long-winded, Nini, rates have been all over the place. They crashed, they went up, they kind of leveled off. They're staying in kind of a flat space now. I think in the United States we'll have low interest rates. They may not go lower than where they're at, but these rates are still considered low. They will remain low for the remainder of the year and even heading into 2021, simply because the system just can't afford to have higher rates. You may see temporary blips where they'll go up, and they'll go up for reasons that I explained. These are more just measures that they need to do to kind of turn the faucet, tighten the faucet, in terms of lending. They have to do that because the system needs to remain liquid and healthy. Otherwise we'll have bigger problems. But lending guidelines are the thing that I'm really trying to watch for. Rates are always going to be volatile, and that's not going to necessarily stop someone from ultimately making the decision to move forward with a transaction or buy. In a refinance, yes, because that's more rate dependent. But if somebody has to move because they're relocating or because they have to get into that school zone for their family or their kids, the rate is not going to be the determining factor. So that's moot. But the other factors will. And I think a lot of that stuff will play itself out, into Q4 and beyond. And that's, that's kind of what we have to look forward to, in our industry.